So you got to really look at intermarket relationships. And right now, the bonds are very key, particularly the long bonds. The long bonds are holding at a support level. And what happens is when there's any flight to safety, oftentimes, until of course the Fed really starts to raise rates, people will go into long bonds. So the long bonds are actually right now outperforming the junk bonds, which are the companies that don't have good balance sheets but pay high yields. And when the long bonds start to outperform the junk bonds, that's a little bit of a caution area right there. But the other key relationships, which is the S&P 500 versus the long bonds, still outperforming risk on. And also, if we take a look at the IYT, or the transportation sector, well outperforming. And that's really what right now is keeping the market afloat, I believe, is actually the fact that people are optimistic about an infrastructure package. So that's really what you got to keep watching. But also, interestingly, we've got these big earnings on tap. I believe that Apple and Amazon and Google, and we already saw with Facebook, are probably going to sell off after the earnings reports. That could have a little bit of a factor in the market, or it could just be we'll continue to see this rotation into small caps and transportation. So the last thing to say about that is to watch volatility, which of course has been beaten up, and volatility is actually going up a little bit today. So you got to look at the volatility, because if that picks up, then I think the market is starting to sniff maybe a little bit of a correction here. But right now, we're still more risk on than we are risk off. It's going to be less likely that the SEC will do a quick approval like what they did with the BETO ETF. And that's because we're talking about now decentralized finance in terms of the coins with Ethereum. And that's more likely that the SEC is going to see it as a security as opposed to Bitcoin, which they were able to see as a store of value. So I'm not saying it won't happen. It just is not going to be as swift as what we saw with the other ETF for Bitcoin. Well, Cathie Wood, no one's going to deny that she is a visionary for the future. And probably in terms of what she's saying, the efficiency of technology that's going to be able to replace the labor market in many ways with robots, with AI technology, with blockchain technology, and then of course being able to do things in agri-tech, so agricultural technology, that will help with the relying on Mother Nature to produce raw materials. She's right, but we're not talking like right away. Anybody right now, as we just finished talking about with the housing market and also with the food market, knows that when you go shopping right now, there is inflation. So she's looking at this from a longer term aspect, and that's why Elon Musk answered her and said, I'm looking at inflationary pressures, and I have to say I'm going to go with Elon on this one. His timing is probably better than Cathie's, except for the fact that they're totally compadre on the Tesla stock. And so I'd say she's 5 to 10 years out in terms of her prediction. So much depends on what happens with the Federal Reserve. So right now, the Federal Reserve is going to have a meeting coming up next week. So that'll be interesting to see what they say. But Powell already said that they want to start taper. So taper has to happen until mid-2022 before they can actually go ahead and raise the interest rates. So we're talking about another 9 months of pretty accommodative rates. So I'd say that with that type of situation, we're still looking at inflationary pressures. We still have a tremendous amount of demand. We still have supply chain issues. And everybody, as I said in the very beginning, knows that if you're going to a grocery store right now, the prices are absolutely insane. Probably what you could buy in, let's say, Whole Foods for $250 now is going to cost you $350 if you're storing up for groceries for a week and you want to eat healthy. But forget about all of that. Just look at the price. Right now, we've got wheat going up. We've got soybeans and corn going up. We have coffee and sugar going up. As long as you start to see those food prices get another leg higher, which is what it looks like it's going to happen, that's inflationary. If you look at silver, it's trading at a ratio now outperforming gold. That's inflationary. If you look at lumber, it got killed and now it's come back, inflationary. So I think right now until it gets out of control. The Fed is kind of hoping for this transitory, that they can get through to, let's say, April, May, or June, and then start raising, but a lot can happen in those few months. I kind of felt like we were at the top of the market in terms of real estate anyway, because what happened was during COVID, there was a lot more demand than there was supply. And that's why there was so much new construction and a lot of buying. There was actually a feeding frenzy in real estate. I could just tell you from our own experience here in Santa Fe, people were putting their houses on the market for these incredibly inflated prices and getting it within like a day. In fact, getting above it because there were bidding wars. That has subsided tremendously. I've seen a lot of reduction in prices from some of those lofty levels already. But in terms of the housing market going forward, there's going to be a few really key factors. Number one is going to be what happens with interest rates. I'd say that's probably the number one thing. And right now, we're still very low in the rates, even though the yields have gone up on the 10-year, which is mortgage related. It's still, when you think about it historically, at 3.5%, even 4%, still so cheap. If that gets much higher, that's definitely going to be a factor. Seasonally now, as we're going into the winter, that will also be a factor, at least temporarily. We see what happens again in the spring. But we're assuming by the spring, the rates will be higher. And then, of course, there's the cost of goods. And we still have high lumber prices, steel, copper. We still have supply chain issues. And so the cost to build has gone up tremendously with no real near-term sign of that abating. So if you put that all together, the housing market will, I don't think, collapse at this point unless we have some crazy event like the market crashes or economically we have some kind of real major event. But it seems like economically, even though we're looking at a slowdown in terms of growth, we're not going into like a major recession. So I would say a long answer to be made very short. We probably have seen the top. We'll see robust demand to a degree, lesser degree, and again in the spring. And if the Fed doesn't have to force the rates up, we should be okay. Otherwise, we'll see a lot of houses come back on the market.